We are not expecting a recession in those markets. And also, if you look at consensus expectations around recession over the next 12 months, it's only around 30%. So, 2 points. One is we're not expecting recession. That's not our base case. And we also think that the markets are not pricing that in if that were to be the case. Of course, there's lots of hope that we can avoid recession and that the Fed can navigate a soft landing. But of course, it's a very fine line.
So how do those markets in the U.S. and Europe compare to perhaps China and the more economic stimulus measures that we continue to see every week?
Yeah, well, so look, I think we would put it in the context of we think there's two big battles going on in the market. And one is inflation versus interest rates, so focused on the U.S. And the other is zero COVID strategy versus science. And of course, the impact of that in China is impacting supply chains and inflation. So those two are very closely tied. For us, we have we basically equal weight view on global equities. We have a preference for the U.S. At the moment, and we'd be underweight China and other EM markets. We think that there's obviously an opportunity in the second half for China stimulus in China, and we're seeing the start of that now to try to reverse course. But of course, if you look at the April indicators, China is very likely to have a GDP decline in this current quarter. They've got lots of arrows they could pull out in terms of stimulus. So really, the question is, what are they waiting for?
What about the risk of a recession in Europe, though? If that's one of your preferred markets, are you looking at the eco outlook and thinking that in particular, that stagflationary risk is pretty high?
So, the problem with Europe is generally growth, and a lot of it has to do with the structure of, politically of Europe and economically. Obviously, what's going on in Eastern Europe has put is a real risk going forward if that spreads. So really, for us, we think that's the biggest risk. Investment in the economy in the face of aggression in Eastern Europe, and I think that's probably the immediate risk against a backdrop of already a low growth economy in Europe in general.
So, but you're still constructive on Europe as a market when it comes to equities?
Yeah, we think everything's got a price. This current year, we think that earnings are likely to be okay for Europe, and so again, against a sort of neutral backdrop for global equities, we would prefer the U.S., but we also don't mind Europe, and that we would contrast that against currently an underweight view on China and EM in general.